Ladies and gentlemen, good day and welcome to the Q1 FY2024 earnings conference call of Healthcare Global Enterprises Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Dr. Ajay Kumar, Chairman for Healthcare Global Enterprises Limited. Thank you, and over to you, sir.
Thank you very much, and good morning and a warm welcome to all those present for the Q1 FY2024 earnings conference. I am here joined today in our corporate office by Mr. Raj Gore, our Chief Executive Officer, Mr. Srinivas Raghavan, Chief Finance Officer, and also the senior management team. I will be sharing our operational financial highlights for the quarter ended March 23. While we have always looked upon Bangalore as being our center of excellence for several years, similarly we are now trying to establish center of excellences in Mumbai, Ahmedabad, and in future in Kolkata. And in this regard, we are also looking at further growth of HCG centers across the country. And I'm very happy to report that we have made an acquisition in Indore, SRG CBCC Hospital, Indore. This is a comprehensive cancer center, 50-bed facilities, and it is scalable up to 100 beds in future, with facilities offering medical, surgical, and radiation oncology. It's the largest private player and leader in Indore in private section. And one of the things we have looked at in the future in M&A is how do we enter central India. We have a strong presence, as we know, in Maharashtra, Gujarat, Karnataka, and in eastern India. This will give us a presence in central India, and it will propel the growth for us in this part of the country, particularly with the hub-and-spoke model we use. With this acquisition and few others we have done, and we are in the process of doing in the future, we will continue to dominate the oncology market in this country. Coming to the medical excellence, what we are focused on, in the field of academic and research, as we all know, HCG has been a pioneer in excellence, data collection, and outcome focused. In future, this will improve the outcome for our cancer patients and, of course, to improve the modalities of treatment. We have also, very proud to say that we have established multiple robotic surgery units across India, and this will once again provide the best of care to our cancer patients across the country. This will definitely bring about a change where our data in future, particularly the work we are doing in the areas of genomics, circulating tumor cells, will continue to position ourselves as a cancer destination. With these few words, I would like now to hand over to Mr. Raj Gore, CEO of HCG, for his comments on the strategies going forward and operational performance. Raj?
Thank you, Dr. Ajay. Very warm welcome to all the participants on the call. Allow me to initiate my comments by elaborating on the recent advancement in this quarter. After consistently delivering organic growth over the series of many quarters, we had stated our clear intention to accelerate HCG's growth through inorganic prospects. We are delighted to share that we have initiated our journey of expansion through inorganic means, successfully completing the acquisition of 2 centers situated in Indore and Nagpur. These are strategically significant and attractive locations in central part of India, and both assets have an already established market leadership position. With our time-tested and highly replicable playbook of driving sustained post-acquisition growth across geographies, we are confident that these two hospitals will contribute to HCG's growth in the forthcoming years. Speaking on Nagpur, you know that we have been operating comprehensive cancer care centers since 2018 in partnership with Dr. Ajay Mehta, who is a minority partner. However, there existed a complex structural arrangement between two entities, HCG NCHRI LLP, which is our operating hospital, and NCHRI, which is 100% owned by Dr. Mehta. Nagpur is a strategic market for us, located in central India. It promises significant growth in future, supported by large capacity. We have a market leadership position that we have already worked hard towards, thereby creating a compelling case to simplify the structure by acquiring stake from Dr. Mehta in both the entities. This is expected to result in enhanced operational efficiency and generate larger economic benefits. With an already existing presence, strong presence in Maharashtra, Gujarat, East India, our pursuit of footprint in central India would strategically position us across larger India. Discussing the performance during the first quarter of fiscal year 2024, we recorded highest ever revenue for the 10th consecutive quarter of rupees 461 crore with a 13% year-on-year growth. This growth was propelled by 22% year-on-year growth in our emerging centers, highest ever quarterly revenue in medical value travel and digital channels, and overall improvement in operating metrics. We recorded EBITDA, excluding ESOP, of rupees 76.4 crores for Q1 FY24 with 5% YOY growth. This lower than expected EBITDA growth was due to subdued incremental EBITDA on account of two factors apart from the annual inflationary cost increase. First, investment in clinical talent. As indicated in previous quarters, we are aggressively pursuing to increase our market share in emerging markets, primarily driven by clinical talent acquisition, which is visible in the growth of our revenues. Second, delayed LINAC installation and upgradation. Downtime and installation delays of LINAC machines at 5 locations resulted in loss of more than 300 operating days on radiotherapy in Q1. This impacted our revenues from radiation oncology, which is a high-margin segment affecting our overall margin profile. However, 4 out of these 5 LINACs have already become operational during quarter 2. We expect this to be normalized in second quarter. In summary, we anticipate improved performance in the coming quarters with the operational LINACs and the operating leverage effect contributing positively to our revenue and margin dynamics. With this, I hand over to CFO Srini for financial highlights.
Thank you, Raj, and very good morning to everyone. We have uploaded our Q1 FY24 financial results and updated investor presentation on the stock exchanges and company's website. And I do hope everybody had an opportunity to go through the same. So let me take you through a few highlights regarding the same. On the revenue front, revenue split between HCG and Milann stood at 96.5% and 3.5% respectively for Q1 FY24. Revenue growth for HCG stood at 14% YOY to 444 crores in Q1 FY24. As mentioned in slide 10, revenue from the mature centers stood at 331 crores, a growth of 11% on YOY basis for Q1 FY24. Revenue from emerging centers stood at 113 crores, a growth of 22% on YOY for Q1 FY24. We are delighted to state that our emerging centers are inching towards maturity and are seeing good traction across geographies. Moving to slide 11, these are the key operational KPIs for our company. Our chemo session increased by 9% YOY, taking the total chemo sessions to 35,000 in Q1 FY24. LINAC capacity utilization stood at 69% for Q1 FY24, that is 67% for Q1 FY23. Onco-bed occupancy stood at 66% for Q1 FY24 compared to 65% for Q1 FY23. I now request your attention to slide 12, where we have disclosed our operational parameters across our mature, network and emerging centers for Q1 FY24. Our company-wide AOR stood at 66.9%, and AOR for mature versus emerging centers stood at 67.1% and 66.4% respectively. Our ARPOB on company level stood at 39,686, and our ARPOB for mature centers stood at rupees 41,253, and for emerging centers stood at rupees 35,766. Across geographies, we are given our revenue breakup in slide 13. Kolkata grew by 54%, Rajkot by 51%, and Ranchi by 27% for Q1 FY24. For our Milan business, revenues for Q1 FY24 witnessed a degrowth of 5% in revenues. On the EBITDA front, our EBITDA excluding ESOP for Q1 FY24 stood at 76.4 crores with EBITDA margin of 16.6%. We have also given bifurcation of our EBITDA across mature and emerging centers. I request the participants to view slide 10 for further details. Other insights on EBITDA has already been shared by Raj, and let me move on to PAT. PAT for this quarter stood at 7.6 crores as compared to a profit of 6.1 crores in Q1 FY23. Our PAT pre-Ind AS adjustments for Q4 FY23 stood at 11 crores as compared to 9.2 crores in FY23, Q1 FY23. ROCE for mature networks stood at 20.2%, annualized for Q1 FY24 as compared to 19% in Q1 FY23, an improvement of 120 bits. ROCE before corporate allocations for mature centers 2.5%. ROCE for emerging centers stood at negative 5% for Q1 FY24 as compared to negative 4.6% in Q1 FY23. Our expansion of existing facilities at Ahmedabad, Phase 2, and Whitefield extension of Bangalore COE is on track. Total planned capex for Ahmedabad is 85 crores, expected date of operations being Q1 FY25, and for Bangalore COE is 25 crores, expected date of operation being Q3 FY25. With this, I would now like to open the floor for Q&A.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Kaustubh Pawaskar from Sharekhan. Please go ahead, sir.
Yeah. Good morning, Dr. Ajay and the other members of the management team. Thanks for giving me the opportunity. My first question is on the EBITDA again. Mr. Raj, you just mentioned that there were two of the one-offs, one of the that is Linac machines were not operational, 5 of the Linac machines were not operational during the quarter. So could you help us to understand how much was the impact because of this loss of operation? Because sequentially on year, if we look into the utilization of the Linac machines, both were higher on quarter-on-quarter as well as YOY basis. So just want to understand, why, there is a loss in terms of, a margin or business. Hello.
Gentlemen, we've lost the connection for the management. Please stay connected while we reconnect them. Ladies and gentlemen, thank you for holding the line. We've got the management line reconnected. Please go ahead, sir.
Yeah. Good morning. This is Kaustuv here. I just want to continue with the question on the EBITDA front. Mr. Raj, you just mentioned that there was issue related to Linac machines. 5 of the machines were not operational, and that had an impact on the profitability because these are the high margin generating businesses for you. So just want to understand, what could be the impact because of this non-operational of 5 Linac machines, and from quarter 2, whether things would normalize in terms of profitability, or will it take some time?
Yeah. Regarding the linear accelerator machine, 3 of them were a replacement. So when you bring down the machine, there's a time lag. We had expected they will be done and operational in the first quarter itself. Now they're all operational in the second quarter. So we are now not going to see any impact in the second quarter. And certainly the numbers, what we have seen in June, are very promising. So we should be able to reach our expected level in the second quarter. Obviously, we will see the further growth of these new machines which are coming in the impact in the second, third, and fourth quarter, which will hopefully meet we think we will meet what our expectation is at point. And also, as Raj mentioned, we are beginning to invest, areas like in Mumbai with high talent. So talent acquisition has also cost us in quarter 1. And that was part of the reason we had this margin issue. But we are now catching up, and we should be able to do well, as I stated, in the second and third quarters.
Right, sir. But talent acquisition, I guess, this is something which will continue because you want to, expand into newer markets, and that is something which is part of your business strategy. So I guess that part will continue going ahead as well.
Talent acquisition is part of the strategy, but when we bring talent at a rather more cost, I think it's cost versus talent. These talent people have come a little bit more expensive than what we normally do, particularly in the high area like Mumbai, and that is why our cost there was gone up. But that will get normalized as we move forward, and as the revenue increase because of these talents, we see increase in the revenue coming from this, and that will get it normalized for whatever is our doctor to overall revenue ratio.
Right. And so one last one on the debt part. So debt has gone up on the books, and you have mentioned the reason that because of the acquisition, the debt has gone up. So should we expect any further, increment in debt considering the ongoing capex which is there on books, or from here we should expect debt levels gradually to come down or remain at, the same position what they are at the current level?
Yeah, the thing is, the debt level that you are talking about is planned for the acquisition that Raj and Dr. Ajay spoke about. But internally, the way we have put our budgets together is most of our capex should be self-funded. So the debt number that you are seeing, I think we should be able to kind of sustain it.
Okay. Thank you. I will get back into this. Thank you.
Thank you, sir. We take the next question from the line of Jay Modi from EIML. Please go ahead, sir.
Yeah, sir, a couple of questions from my side. So first was around the chemo sessions. In previous quarters, we've seen the growth to be higher at around mid-teens to high teens, whereas this quarter we've seen 9% growth. So any particular reason for this?
Sorry, can you please repeat your question?
Sure. Am I audible now?
Yes.
Yeah. So my question was around chemo sessions growth. In earlier quarters, we've seen this growth to be higher at mid-teens to high teens, whereas this quarter we've seen only a 9% growth. So any particular reason for this?
Why chemo is growing lower?
So these chemo numbers were also higher in the previous quarters because some of the centers in the emerging markets were ramping up. Like, for example, Jaipur and Nagpur, those centers have led to the higher volume growth in our emerging centers, thereby leading to overall volume growth in chemotherapy. So these centers are sort of normalizing. However, we expect these numbers to be further driven by Calcutta and Mumbai going forward.
Okay, and do these sessions have any element of price increase, or what is the volume growth ideally translates to revenue growth for us?
So typically what we are seeing is, while price increase, we take an annual price, inflationary price increase to the extent of about 5%. However, we are seeing some change in adoption of molecules in medical oncology. Larger and larger adoption of immunotherapy in medical oncology is leading to higher average realization. I would like Dr. Ajay to further dwell on this.
Yeah, on this matter, we are seeing a change in the approach how we manage our oncology patients. There are two things here. One is, we all know cancer patients are now living longer, and cancer has become a chronic disease. So as repeat cancer patients come back, and when we do the first-time right treatment, there are certain number of people who will recur. And particularly for them, and even for first-time people, as technology advances and as more genomic studies and all come, when we become more patient-specific, we are beginning to see treatments like immunotherapy becoming very prominent, apart from genomic testing. Because of this, immunotherapy drugs or patented drugs, they are quite expensive. So you will see a definite ramp-up in our oncology section, where our revenue is increasing. Our percentage of oncology contribution in medical oncology is also increased. So this is what we are beginning to see. And this may be only the beginning, because in the future, the therapies like immunotherapy will increase significantly.
Got it. And in chemo sessions, in chemotherapy, do we have any element of scheme-based patients wherein the government foots the bill, or it is largely the private patients which forms the majority of share?
Even in scheme patients, it is gradually happening because now the states like Odisha, to some extent Gujarat, probably Maharashtra, are beginning to recognize the importance of this kind of targeted therapy. And even though they are expensive, they are beginning to approve. I think, of course, it is all related to the budget of these people, what the states have in healthcare. So they will have a final say yes or no. But in the long run, I think states will have to recognize. And at some point, of course, they will become generic. That will become far, far cheaper for governments to approve. But we are beginning to see the trend.
And if I can just add, Dr. The question was also that whether chemotherapy includes scheme patients.
Yeah.
So just to mention that our scheme patients distribution across the modalities more or less are similar. Our little skewed on a positive side in chemotherapy, primarily led by our tier 2 centers where we see late stages patients, and late stages patients typically undergo medical oncology. So that actually leads to a little bit of skewness. And those poor patients who probably get diagnosed late are funded by the scheme patients, thereby leading to little bit of skewness in chemotherapy from scheme patients.
Got it. And sir, what is the ideal mix between, what is the share of scheme patients in our overall revenue, scheme-based patients?
Scheme patients. Government, what's the percentage? Including CGHS. When you talk about only schemes, which is like a Ayushman scheme and all that.
Yeah, so Raj here. When we look at BPL and state schemes, share of those schemes is about 20% of our total revenue.
Got it. That was helpful, sir. Sir, next question was around Milan. So we've seen a lot of competitive pressures building up. Lot of players coming in, lot of deals happening. So could you speak a bit about the competitive intensity that you are seeing on ground, and also any particular reason why we've seen a steep decline this quarter?
Yeah, Milan, as far as Milan is concerned, as we know, we are quite a dominant player in Bangalore, and we are sticking to that dominance in Bangalore. and we have put a lot of systems in place to grow. Unfortunately, there was a slight drop in the Milan revenue because of the regulatory surrogacy, which formed a art which the government regulators had taken time. Now that has been cleared. All our centers have a certificate, and we are beginning to see a healthy ramp-up happening. In fact, to July, it has already happened. So we are focusing on Milan to make it center of excellence, good quality outcomes, and this kind of approach in Bangalore only. Our future growth primarily will be in Bangalore, and we have a center in Delhi which has not been doing good. We are shutting down the center in Delhi. We are also, the Chandigarh center is doing. They are putting some efforts to improve. But apart from that, the greater Bangalore area where we will be growing, and we don't see that much competitive pressure. We have others who are also doing it in Bangalore, but because I can see long term, we have our Dr. Kamini Rao. I think in the future we will be able to come back and grow and certainly reach a leadership position.
Got it. And sir, typically what is the cost of setting up one Milan center? Is it a very cost-intensive affair?
No, it is not cost-intensive. It costs about roughly 3 to 5 crores is the cost, right, Raj?
Yeah.
You want to say anything, Raj?
No.
Okay. And my last question was around the margin. So, a couple of years we've undergone the consolidation that we've had, right? We were trying to consolidate our centers and become far more profitable than what we've been in past. Now, this year we've seen 2 acquisitions and couple of brownfield expansions taking place. So, do these expansions or acquisitions in any way impact our margins in shorter term? Because it will naturally take us some time to ramp these up to our optimal level.
The company has charted out all the expansionary plans unit by unit, and at some point of time we will guide of all the comprehensive expansionary plans. However, where we have already expanded, and if it is a vertical expansion of our existing facility, we expect operating leverage to play out and margin should expand. Yeah. Now, for example, in our acquisition pursuit also, for example, Dr. Ajay just announced about Indore. We expect we would be expanding. Right now, the facility is about 50 beds. In the adjacent land, we expect to build one more building, cancer care building, which should be 100 bedded. And we expect that market consolidation to happen with a better margin. So, this expansion, I don't know whether this question is related. However, the 2 acquisitions which we have announced should add to about 14 to 15 crore of incremental EBITDA during the financial year.
Okay, that is helpful, sir. Thank you and all the best.
Thank you. Before we take the next question, a reminder to all the participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. Ladies and gentlemen, if you wish to ask a question, you may press star and 1 on your touchtone phone. We take the next question from the line of Karan from Monarch AIF. Please go ahead, sir.
Hi, sir. Thank you for the opportunity. Am I audible?
Yes, sir.
Yeah, Karan. Hi.
Yes. Hi. So, we have been guiding for margin improvement since Q2 FY23 earnings call. And if I zoom out a little bit, it was mostly being derived from 3 aspects. So, number 1 was our cost efficiency measures derived from consultants coming in and making us more efficient, leaner, better pricing in different emerging centers, etc. Number 2 was obviously our operating leverage playing out and making many emerging centers going towards maturity and doing better EBITDA margins. And then 3rd was obviously our consultant costs waning off, which were one-off. So the margin expansion, what we were hoping for, or to the trajectory we were hoping for, was around to the tune of 150 bips to 200 bips on an adjusted EBITDA basis. However, we have only done around 16% reported, and adjusted EBITDA margins for us for Q4 FY23 was around 18.8%. So, sir, I just want to know more contours, more color on what really went down this quarter and why were we flattish in absolute EBITDA and perhaps lower to what maybe 18.8, so 200 bips in Q1 FY24. from an adjusted EBITDA perspective? Because this is counterintuitive to the consultant cost that we took on and operating and efficiency benefits which should have flown in. And just follow up on that would be, further cost line items. Can you just highlight some cost line items in other expenses which were the most impacted? And what does that mean for us in terms of, mean reversion to 19% and then expanding it to 20-21%? Does that look much harder to achieve in FY24?
Yeah. So, Karan, I'll just break these into 2-3 pieces. See, you're right that now our reported EBITDA was almost close to about 19%. Adjusted EBITDA was close to about 19% in the quarter 4. Now, just to substantiate whatever Raj and Dr. Ajay said on radiation business, and the key themes which we have put out was our radiation business not being as per our expectation because of the downtime in the Linac machine. That has costed, and if you see our previous reports, radiation business used to constitute about 18% of our business, which has gone down to 17%. And that we believe is more of a quarter 1 phenomenon and should pick up going forward. Now that 1% of business is close to about 4 crores, and 4 to 4.5 crores. And we operate somewhere around 80% margin on radiation business because costs are all built in. The consultant costs are there. There is no higher consumables on this. So costs are all built in. Now we expect a higher leverage coming, operating leverage, positive operating leverage coming out of this in the coming quarters. Further, as we know that in healthcare, we all the hospital groups, they take annual price increases, inflationary cost comes in, and subsequent quarters start to see positive operating leverage on that. We have already started seeing positive operating leverage from June onwards because we take it in the month of April. So that we should see that would play out. On those, yeah. Third is, again, speaking to what Raj said on the investment in doctors and primarily happening in our emerging markets. It is, I would not say it's more or less done. It has been happening from quarter 4 and quarter 3. We had also announced that we are investing in these markets through our clinical talent acquisition, continue to do so, and that is reflected in our revenue growth. So, at some point of time, if not quarter 2 alone, from quarter 3 onwards, we should start seeing operating leverage on doctors' costs also being played out once the revenue starts ramping up further. So we are confident that, this is one of the quarters where 2-3 variables has gone against us, and we should be able to bounce back in the coming quarters. And one more thing was you touched upon our consultant costs. Just to restate that our consultant cost has been taken off. From quarter 1, we have not had any consultant cost which was there in till quarter 4 of last financial year. So, and we had also stated that large part of those benefits, almost about 70-80% of those benefits were accrued in the previous financial year only. Only 20% was remaining that we should see in coming quarters.
Got it, sir. Got it. So, sir, on the emerging center side, we are doing EBITDA margins of close to 9 to 10% depending on which quarter we see, right? Can you just tell us what levers we have to take it towards the 15% kind of, or mid-teens or low teens kind of an EBITDA margins going forward?
See, I think one thing I would say is the one acquisition which we just announced, Nagpur, where we had a complex structure, that itself should add to our EBITDA margin of emerging buckets to an extent of about 40 basis points to 50 basis points. Now, other levers are primarily operating leverage in nature because we do believe that 80% or 90% of our investment in clinical talent as well as market making is done. As the revenue plays out, we should be able to see this operating leverage coming in, and somewhere around the number you just mentioned, we should be closing it in quarter 4.
Understood.
Just to isolate few of the well-performing centers, our Borivali center is already 20% plus margin. Jaipur center is also in close to 20% margin. It's primarily, our whole focus is on 2 centers in the 24 centers portfolio is Calcutta and South Mumbai. These are the 2 newest centers, and we are not right now focusing on margins on those centers. We are focusing on revenue growth. We are happy with the revenue growth which is coming in, and we do believe that EBITDA margins will play out in the future quarters.
And sir, we feel similarly for our Kolkata as well as South Bombay centers? Because we've been investing in clinical talent and, trying to get that up to EBITDA break even and obviously a much better EBITDA on those centers. How are we on those centers currently?
So Kolkata and South Mumbai sort of pulls down almost 1 to 1.5% of overall EBITDA margin of the company. So when these centers break even, that itself will take our margin higher by 1.5%.
Understood. And sir, what would be the timeline for that according to you? How do you feel it internally?
We should be able to achieve that in around fourth quarter of this year.
Understood. And sir, just one last question from my side. Can you just highlight what was the total acquisition cost for both Nagpur and Indore? I understand that we've levered our balance sheet around 100 plus crores for this acquisition, but I'm assuming that some bit of it will have been spent through internal accruals as well. So what was the total spend on both these acquisitions that we've done?
So it's like, what we are saying is our net debt would go up by 107 crore. While the funding, the company is having enough sufficient cash, plus it also has debt lines. So both sources of funding are available to us. However, because of that 107 crore of cash going out, our net debt should increase by 107 crore.
Oh, okay. Understood. And sir, I was just going through your press release on Indore, and I couldn't see a reported EBITDA on the Indore center. Can you just call out, sir, what reported EBITDA is for the Indore center currently?
So it seems like right now the company is also in the middle of doing some more deals. So purposefully, right now we are not in a position to sort of disclose some of those parameters. So that's why we have put together that both the centers put together, our EBITDA should be higher by 14 to 15 crores per annum, and the resultant net debt is about 107 crores. At an appropriate time, once we get into those situations, we'll disclose the EBITDA as well. So we do not want to reflect on some of the things which can just sabotage our position of future deals which we are talking about.
Understood. That's it from my side, sir. Thank you for your time.
Thank you, sir. The next question is from the line of Aditya Khemka from InCred PMS. Please go ahead, sir.
Yeah, hi. Thanks for the opportunity. Can you elaborate a little on the clinical talent that you guys are investing in? What are these people doing? Why were they hired? And how is it that they will help you to increase revenues? If you could just elaborate a little more on that.
Is the question about what type of clinical talent? Aditya, we have, as we know, Mumbai particularly, we have been really trying to acquire significant clinical talent in the field of medical oncology and particularly in surgery. And in this field, we are very happy to say that we have been able to recruit one of the star medical oncologists from UK. He was the director of the breast program in Nottingham, which is a big cancer center, Dr. Sachin Trivedi. And he has joined us. He has been full-time since June. And so that is one of the things as we go forward, we will see that he is being positioned as a director of medical oncology in the region. And his job is to really not only recruit talent for his department, apart from breast cancer, he'll be looking at entire solid tumor oncology. And also he'll be building a team. In this regard, we are also happy to say Dr. Veeni Krishnamurthy, who is a lady breast surgeon, a renowned breast surgeon, trained in Sloan Kettering in New York, has also joined us for South Mumbai. And her role is to really work on the breast cancer in women and see how we can make it a center of excellence for breast cancer in South Mumbai. Both of these talents, apart from several of the associate talent we have recruited, so we are trying to create a center which is doing well, and our South Mumbai center which has got different talent and technology to really look at a center of excellence. That is where we are positioned and going forward. And also we will cater to international market. And apart from this, to make it a center of excellence in Mumbai, Borivali, we have just installed a robotic therapy, which will also improve our talent acquisition, as already done in terms of uro-oncologists. So with this, we will also see significant growth in the surgery, as well as, of course, it will be truly a center of excellence with all the available technology being present in under one roof.
Got it, sir. So these talent that you have acquired is basically doctors? Majority of it is doctors or all of it is doctors?
Yes, mainly. What was the question? The talent is we acquired only the main doctors. The talent is for mainly doctors, but as you know, we are a big training center. So all of this will propel people to come for the residency programs and improve. So with the Center of Excellence will have all the residency program associates. So it will go, and we will be looking at data from it, outcome from it. So many things will happen when we have a talent like this. This will definitely improve. And we are also, along the same lines to improve this kind of acquisition of talent and build. We are also putting a third, we are putting our robot also in Kolkata. So all of this will bear significant benefits for us. For our cancer patients, of course, that is the best, that is the most important thing. But we'll also add to our top line and also improve our efficiency and bottom.
Got it. And so I think one of the concerns that investors have had for some time now is, stories or streets say that your primary investor, which is CVC, might look to exit in the near term. Can you throw any lights on that? Anything that you would like to share with us? If there is a near-term exit of the private equity. Thank you.
At this point, as we know, CVC said that they are there for long term and they may exit whenever time they think is appropriate. It is best that you ask them what do they think. As far as I am concerned and Raj is concerned and the entire management team, we are really working hard to expand our oncology, and they have been very cooperative in it. I think they have been a very good partner financially and also strategically for us. So we are really enjoying this partnership we have for further growth of oncology.
Understood, sir. Thank you and all the best.
Thank you, sir. The next question is from the line of Abdul Kader Puranwala from ICICI Securities. Please go ahead.
Yeah, hi, and thank you for the opportunity. So my first question is on this Indore facility, what you have acquired. So if you could highlight, what is the kind of, surgical revenue on oncology front which the center is doing, coupled with that on, some details on the operation part like the ARPOB and occupancy. If you could share, please.
Which center?
The Indore facility. So what you have acquired?
Indore facility. Yeah. Indore facility has both surgery, radiation, and medical oncology. It is a comprehensive cancer center, and it is rated actually number 2 in surgical oncology in the city. And there is also scope for further expansion. And we are also in the process, as we know, with our partner, we have an agreement to build a bigger cancer center with Dr. Rajesh. So once we complete this acquisition, which we have done, we will begin to grow here. And now the surgical number of surgeries here will increase once we go into the new center. And our goal is to become the premier center in Madhya Pradesh with this acquisition and the future growth plan we have. Raj, you want to add?
Abdul, Indore Center has a number 1 market share in private cancer care in Indore. It's a very established center. In all modalities, it has a top 3 position. It has a very high percentage of good margin business. It doesn't do any scheme business. It has cash TPA business. It has in an existing facility, we can grow this revenue, and we have a plan to add another center in coming 2 years, so that we have a path to grow it sustainably in future and dominate that market.
as in a number one market player.
Got it. So secondly, on this impact of addition of this Linux on your EBITDA margin, what you've called up for. So I think in the last call you also indicated that you may be adding, 7 to 8 more at a future date. So I mean, is that still on track, and will that happen in FY24, or you plan it to do as when there is some necessity coming up?
Yeah. So apart from these 5 machines, we are also evaluating adding a machine in Kolkata, in Nagpur, which will probably come, and Vizag, 3 of our well-performing centers on radiation, which will probably come, beginning of next year. So we are on track. We are already preparing the bunkers, etc., ready, and we should be able to, grow that radiation business in these 3 centers in the coming year, next year.
Thank you. We take the next question from the line of Ankit Agarwal from Yellowstone Equity. Please go ahead, sir.
Yeah, hello. Thank you for taking my question. My first question is on the Nagpur center. We were already owning 76% and now we have gone to 100%. Is that right?
So there are 2 developments in terms of Nagpur. As Raj mentioned in his earlier speech, the structure was a little complex. There was an infrastructure company and there was an LLP. LLP was the operating company. There was a revenue share arrangement between the 2. Now we are buying the entire stake in the infrastructure, by which we will be able to consolidate the entire operations, which will give us better leverage on operational efficiencies, but also economic benefits.
So, and also the 26% of our partner has been acquired fully by us, 10%. So both places will become 100% owner. That is the bottom line.
Okay, so that's why there is some EBITDA contribution, because otherwise the operational EBITDA would already be in there in the consolidated numbers. Right? I mean, when you say 14 to 15... Right. Okay. Understood. Okay, that's all I had. Thank you.
Thank you. We take the next question from the line of Mahesh Atal from Atal and Associates. Please go ahead, sir.
Sir, my first question would be regarding your debt metrics. I mean, what is the plan to deleverage the balance sheet going ahead? And where do you see the debt levels by end of this year, financial year 24 and financial year 25? And coming to your ARPOB numbers, from the existing centers, when can we, expect this to reach the levels, marginal levels? I mean, how exactly are we, pushing it to come to the, the mature centers levels, and when do we see the numbers coming in? My 2 questions will be this.
Yeah, let me first take the debt part of the question, and the second part will be taken by Raj. See, if you see the debt numbers as it stands today, if you see what we have shown in the investor presentation, I'm talking about real debt. Bank debt is about 217 crores, and we are trying to add about another 107 crores, largely to fund these acquisitions. But don't look at debt in isolation. These acquisitions, as my previous management members said, they are all coming with a positive EBITDA margins, and that will only kind of, support this debt. And if you look at it on an overall basis, as I mentioned, we are looking to fund most of our capex from our internal accruals. Any debt will be as far as would be only for the acquisitions and activities, which will be both revenue as well as EBITDA accretive. So we are largely looking at to keep a debt level in the range of about 2 to 2.5 times of debt to EBITDA. That's the kind of leverage we are looking at, and that is the way we are looking at it.
Okay.
Mahesh, on your question, Go ahead, Mahesh.
Yes, sir.
Go ahead, Mahesh.
Yeah, sir, just one question there. So when we say that we are going to, I just wanted to know what could be our spend per bed when we are going for an expansion. Let's say we are starting a new hospital tomorrow, and then what would be the cost per bed, and what would be the payback period for that particular bed? Let's say per bed occupancy, what would be the payback period at this ARPOB level? Let's say I calculate it on.
At this point, Mahesh, at this point, we are not doing any greenfield. Like what Srini said, we are only acquiring hospitals which already have a positive revenue and EBITDA, and so this will be based on obviously at a lower EBITDA times, and that is what we are acquiring them at. So it will be definitely beneficial for us in terms of further expanding it and becoming dominant in those regions. So we are not doing any greenfields to give you any details about what will be the cost of hospital expansion and all. We are not doing greenfields. Okay? At this point, except, what we call it in Bangalore, whatever expansion we are doing in Whitefield and all, it is part of the Bangalore dominance expansion. So we are not calling it truly greenfield. It is expansion of our existing centers. That is how we are dealing. So similarly, in Ahmedabad also, we are building a new center. Similarly, in Ahmedabad also, we are building a new center because we run out of space. So that will have a huge positive potential as we go forward.
Yeah. So, sir, the metrics behind any brownfield expansion is that are we looking at hospitals which have ARPOBs in line with our existing centers, or they are a little lower and we are trying to bring them up? How exactly are you looking at it from here on?
So, Mahesh, the investment thesis primarily what we have today, as Raj said, Dr. Rajat said that we are not looking into, majorly not looking into greenfield. Any acquisition which we are taking, what we are seeing is it should be at least at par or accretive to our return on capital employed. Now, when that happens, and typically, and you also touched upon payback period, we are expecting, based on the headroom available and whichever targets we are taking, we should be able to have a payback within 6 to 7 years at the capital level. Now, once that happens and you have enough headroom available to grow, that makes a viable business sense for us. So this is how sort of broadly we are looking at any future investment or brownfield which we do.
Right, because sir, also one more thing, that operating leverage in our business will come only when you are actually operationalizing the beds, right? I mean, just wanted to understand that thing, where exactly the operating leverage in our business come from.
See, absolutely right. I mean, when you operationalize your bed, bed occupancy goes up, your revenue goes up, and then operating leverage kicks in. And we have been saying that, look, I mean, we have an isolated focus on certain centers which is pulling down the entire portfolio. If you look at our existing centers, the margins are healthy, the return on capital employed is healthy, and if you just look at Calcutta and Mumbai centers, then we are well within a decent satisfactory position both in terms of profitability and return. The pursuit, and that's why we have been stressing upon these two centers all the time that right now we are not looking at profitability. We feel that if we do good in terms of increasing our share in those regions by doing the right things when it comes to market making and clinical acquisition, profitability will follow through in coming days. And we are all, as I said, as we said, we are already sort of seeing the improvement in EBITDA, and we should be able to do that in Q4 of current year. If you look at our slide number 10, we have been writing on an increasing path, on a growing path in EBITDA. So our EBITDA in Q4 from emerging center was 81 million. It has gone to about 99 million. And we expect this would keep growing in the future quarters.
Fine, sir. All right. Thanks a lot and all the best.
Thank you. The next question is from the line of Karan from Monarch AIF. Please go ahead, sir.
Hi, sir. Thank you for the opportunity again. Sir, sorry to ask this again, but I'm still confused on the total acquisition cost. I understand that you gave that breakup of, the debt plus the cash bit. But if you can just call out the total acquisition cost to company, that would be with debt, with internal accruals, etc. The total cost that would be really helpful, sir.
So, just to say, our net debt is going to increase by 107. Of that 107, 30 crores of debt is what we will be consolidating from NCHRI. If you take out that debt of 30 crores, the next 67 crores would be primarily towards acquisition cost, but not 67 crores, 30 crores. 77 crores would be cash out from the system, either in the form of debt or cash going out. That is the total consideration being paid for the two acquisitions.
Understood. So 77 crores we are actually paying because 30 crores that we are getting on our balance sheet from the Nagpur center. Is my understanding correct, sir? And that's why we're coming to that debt figure.
That's right.
Okay. Thank you. Thank you, sir. Thank you so much.
Thank you. Ladies and gentlemen, that was the last question for the day. I would now like to hand the conference over to the management for closing comments.
Once again, thank you for your interest and support to HCG. We are happy to have further conversation. If you want any more clarification, please feel free to reach out to our investor relations. Thank you for joining. All the best.
Thank you. On behalf of Healthcare Global Enterprises Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.